Hey everyone, if you're a business owner, you've probably stared at two documents a million times, the balance sheet and the profit and loss statement. But what's really the difference between them? And more importantly, how do they work together to give you the full story of your business? Well, let's find out. The classic question, right? The one that keeps so many of us business owners up at night. Your P&L statement is screaming that you made a profit last month, but you look at your bank account and, well, it's not looking so hot. It is a super common dilemma, and trust me, understanding these two statements is the key to finally solving that mystery. So to really get what's going on with your business's finances, you can't just look at one report. Nope, you need two totally different lenses, and each one shows you a unique and totally vital perspective of your company's health. Think about it like this. Okay, if there is one thing you take away from this whole thing, it's gotta be this. The balance sheet is a snapshot, like a photo that captures your business's financial position at one specific moment. The profit and loss statement, that's the video. It tells the story of how you did over a whole period of time. All right, let's zoom in on that snapshot first. The entire job of the balance sheet is to show you three things: what your business owns, what it owes, and what it's worth, all on one single day. And the keywords here, the thing to really lock in, is a single point in time. It could be the last day of the month, the end of the quarter, whatever. Just like a camera flash freezes a moment, the balance sheet freezes your finances for that one instant. Okay, let's take a look at a super simple example for a made-up business we'll call Company X. This is their snapshot on March 31st. Over on the left, you've got assets. That's all the stuff it owns, like cash and inventory, adding up to 12 grand. And on the right, you've got liabilities, what it owes to other people, and equity, which is basically the owner's slice of the pie. And here is where the magic of the balance sheet comes in. It has to, always, balance. The stuff you own, your assets, has to equal the stuff you owe, your liabilities, plus what belongs to the owners, the equity. You can see it right here. $12,000 in assets equals $4,100 in liabilities plus $7,900 in equity. See? Perfect balance. So, what's this photo really telling us? Well, Company X looks pretty healthy. It's got a positive net worth, its debt is pretty low, but, and this is a big but, notice that less than half of its assets are actual cash. A lot of its value is tied up in things like inventory and equipment. Just keep that little detail in the back of your mind. It's going to be important later. All right, snapshot's done. Time to hit play on the video. The profit and loss statement, or P&L for short, is going to show us what happened in the story that unfolded after we took that photo. It covers the entire month of April. Yeah, so unlike the balance sheet, which is just one moment, the P&L, it's all about the action over a period of time. Its whole focus is super simple: money coming in versus money going out. And this slide just lays out that journey perfectly. You start at the very top with your gross revenue. That's every dollar you made from sales. From there, you subtract what it costs you to make or buy the stuff you sold. That's your COGS. That leaves you with gross profit. Then you subtract all your other bills, rent, salaries, you name it, and bam, you get to the famous bottom line, net profit. So what's the verdict for Company X in April? Well, the video has a happy ending, a net profit of $4,100. They made more than they spent. Fantastic. But how in the world does this connect back to our snapshot from before? Okay, people, this is the moment. This is where it all clicks. We're about to see how the video from our P&L actually changes and updates the photo from our balance sheet. This is the crucial link that, honestly, trips a lot of people up. All right, let's bring that first photo back up. Remember this? This was our starting line. Company X on March 31st. I want you to keep your eyes on the checking account, the bank loan, and that whole equity section over on the right. So that $4,100 in profit from April's video, where does it go? It doesn't just disappear into thin air. Nope. It flows right into the equity section of our balance sheet. It gets added to the net income line, which increases the overall value, the overall worth of the business. It's the reward for having a good month. But hold on, that's not the whole story. Other stuff happened in April that you will not find on the P&L. For example, the company paid down $200 of its bank loan, and the owner took out $1,500 for themselves. We call that an owner draw. These things are purely balance sheet moves. They just shift value around, but they aren't business expenses.
And here it is, our brand new updated snapshot as of April 30th. Just look at the changes. The checking account is bigger, the bank loan is smaller, and that net income number in the equity section has grown by the exact amount of profit from April. The whole financial picture has literally evolved. And check it out, the magic is still there. After all that activity, the profit from the P&L, the loan payment, the owner taking some cash, the fundamental equation is still true. Our new snapshot is in perfect balance. It just proves how these two statements are permanently, dynamically connected.
Okay, let's quickly run through those key terms from our little journey again, just so they really sink in. First up, gross revenue. Simple, it's the top line number. Every single dollar that came in the door from sales, before you account for a single expense. Next, we have gross profit. This is the profit you made just from selling your products or services. It's your total sales minus the direct cost of creating or buying what you sold. And finally, the big one, net profit. The bottom line. This is what's really left over after every single bill is paid, from materials to rent to marketing. This is the number that actually grows your business's value. So, to wrap it all up with our big idea one last time, the balance sheet, that's your photo of your business's worth on a single day. The P&L, that's the video showing its performance over time. And that video is constantly, day by day, updating the photo, giving you this living, breathing view of your finances. But this leaves us with one last kind of sneaky question, doesn't it? Company X made a $4,100 profit in April, but its cash only went up by $2,400. So, if you're making a profit and the books balance, where in the world did the rest of the cash go? Well, that, my friends, is a whole other story, and its name is the cash flow statement.